The three things that we're going to talk about are a cash out refinance, we're going to talk about a HELOC or home equity line of credit, and we're going to talk about a second mortgage. I want to do this renovation to my home. I want to finish my basement. I want to build a garage, but I don't exactly have the funds or the resources to be able to make that happen. What are my options? We actually just had this call earlier this week. And frankly, it boils down to sort of three different options for you to use the equity of your home to create cash to do those types of things. A lot of these are in the media. A lot of them have been in the media in the past. So first off is the cash out refinance. This has been a huge item in the news for a couple of years, because for quite a while in 2020 and 2021, interest rates were low and getting lower. The idea of a refinance in general was a great idea for most people. If you had a mortgage that was 5%, when interest rates dropped to 3.25, it made sense for you to refinance your mortgage and be able to draw cash out on the equity of the house. Most banks and lending institutions are only going to allow you to borrow up to 80% of the home's estimated value. Now, they're going to determine that value typically from an appraisal. So the appraisal determines the value. They will let you draw until you are at 80% of that total appraised value. So if you are in a home that is worth $200,000, then they will let you draw until your mortgage is $160,000 or less. So if you owe $150,000 on your property, and they'll let you draw up to $160,000, you've got $10,000 there potentially that you could play with on a cash out refinance. That $10,000, if you were to want to cash that out, you would actually refinance the entire balance of your remaining mortgage and the $10,000 that you draw. The reason that might not be the best idea today is because for a lot of people, they either refinanced during 2021 or purchased during 2020, 2021. Their interest rate may be lower than the rates are currently today. Today, rates are sitting at about 6%. If you have an interest rate locked in at 3.25, refinancing the entire balance of that loan in order to withdraw that $10,000 might not be the best option for you, because you're going to end up paying a lot more interest over the life of the loan. The good news is there are a couple of other options. The second option we're going to talk about is the HELOC. It's a home equity line of credit. Basically, what they're going to do is they're going to open an account over here, and they're going to take that $10,000 and lob it into this account, and they're going to give you essentially a debit card with access to that account. You and your lender get to determine how long you have access to draw money out of that account and how long you are agreeing to spend to repay it once you draw it. The benefits of a HELOC are that you have access to potentially maybe more than you would need. So if you're not quite sure how much your project is going to cost, you could withdraw a little bit more and you have a little cushion. If you withdraw, your $10,000 and you only end up using $5,000, then you're not paying interest on the portion that you didn't use. So the interesting thing is, they put this $10,000 into an account. You're only paying interest after you draw it out of the account, right? So you're not having to pay interest on the full balance if you don't use the full balance. The other benefit is that if you need a longer period to draw money, those draw periods can be up to 10 years long. And so that can be a benefit to a lot of people too. The negative side though of a HELOC is it is a variable interest rate. So where interest rates are today may not be where they're at 4 years down the road when you're still drawing out of that account. That's something that you would want to keep an eye on. That leads me to our third option, which is what we call a second mortgage. Second mortgage is similar to these other products in that it draws from the equity of your home. It's just simply done in a little bit of a different way. The same process happens. You have an appraisal. They'll allow you to take up to about 80% of your loan to value ratio. What they're going to do is just literally open up a second mortgage for you on the property. They're going to write you a check for that $10,000. They're going to say, here's your $10,000. This is the interest rate on it, and you simply repay it over a period. Second mortgages are 15 years, 20 years, whatever that period may look like. You just repay it like you did with your first mortgage. And so you just have this lump sum of money. Unlike a HELOC, you wouldn't be able to necessarily get more if you suddenly needed more. If you didn't use all of it, you're still paying interest on all of it. There are some benefits and some detriments. The benefit of a second mortgage as opposed to a HELOC is is that it is at a fixed rate, the same as a first mortgage would be. The interest rate is a little higher than your first mortgage, but it is fixed, so it's not going to be volatile with the market. Those are sort of the three different options that you could look at if you needed to draw a sum of money out of your home equity. To be clear, you don't have to reinvest that into your home. I think it's a smart idea to reinvest it into your home, because if you are borrowing against your equity and then creating more equity, then you're literally using your money for good, right? I mean, you're using your money to build more equity in the property, and that's a win-win against your mortgage. So that's great if you're going to finish your basement or add a bathroom or put an addition on the back of your house. That's a great use of those equity funds, but that's not the only thing you can use them for. Things come up all the time, whether it be medical bills or a wedding that you have to pay for, and you can use those funds for any of those types of projects. It doesn't have to go against the equity of your home. Just something to keep in mind. Those are the different sort of options that exist out there. If you have questions about your individual project, or if you even need some guidance on where we think your home's equity might be right now, I'm more than happy to give you a broker opinion on what your home's equity might look like today before you invest in having an appraisal done, for the bank to see what that looks like. If this content was just what you were looking for, please like and subscribe to our channel for more information just like this.